Okay, imagine this. You're sitting at the head of the table of a media empire, a real giant, but you can feel the ground shaking underneath you. Today we're stepping right into the high-stakes boardroom of ProSiebenSat.1, a German media titan that's facing one single decision that could either lock in its future or, well, seal its fate.
And guess what? That decision, it falls to you. We're putting you right in the hot seat. You've got two choices on the table: a huge, risky bet on the future of entertainment, or the much safer, more traditional path. So, what would you do? By the end of this, you're going to have to make that call.
All right, so here's our briefing for today's big meeting. First, we'll get the lay of the land, who ProSieben is. Then we'll dig into the double threat they're facing. After that, we'll analyze this bold, all-in strategy that's on the table, weigh the pros and cons of focus versus diversification, and then, yep, it's your turn. You make the call.
So, first things first, who are we even talking about? ProSiebenSat.1 is, to put it simply, a king in the German-speaking media world. I mean, for decades, they have absolutely dominated free-to-air television. But as we all know, every kingdom, no matter how powerful, can find itself under siege.
Now, to really get a handle on their empire, you've got to look at how they built it. See, it wasn't just about TV. For years, yeah, about 80% of their money came from traditional TV ads. But that other 20%? That was their secret weapon, a whole collection of e-commerce and venture businesses. Think of it like a financial lifeboat. It was there to protect them whenever the stormy advertising market got a little too rough. Honestly, it was a brilliant hedge.
But that lifeboat, it's now being tested like it has never been tested before. The company isn't just facing one storm, it's caught between two. It's like a pincer movement, and it's forcing this massive, dramatic decision.
And this slide just illustrates it perfectly. It's a two-front war. On one side, you've got this global invasion, right? Streaming behemoths like Netflix and Disney Plus are just swooping in and pulling viewers away from regular TV. And then on the other side, there's this intense local pressure from an activist investor, Media for Europe, MFE for short, which happens to be run by the famous Berlusconi family. And they're not just suggesting changes, they are pushing hard for a huge merger.
And make no mistake, this pressure is serious. MFE has bought up nearly 30% of the company. That is a massive stake. When a single shareholder owns that much of your company, they aren't just making suggestions anymore. Their voice can shake the entire boardroom and pretty much force a decision.
So here's the bottom line. Both of these threats are hammering the company's very foundation. The business model that made them a giant in the first place, selling ads on good old-fashioned scheduled television, is in a structural decline. Fewer people are watching, so ad revenue is shrinking. This isn't just some temporary dip. It's a fundamental shift in the entire market.
So, what's the answer? Well, the CEO, Bert Habets, has put a bold, an almost audacious plan on the table. A plan to fight back by going all in on entertainment and building their very own champion.
Meet Join. Now, this isn't just another streaming app. The vision here is to create the super streamer for Germany, Austria, and Switzerland. A single dominant platform, supported by ads that can go head-to-head with the American giants by offering that must-see local content you just can't get anywhere else.
And here's the data point that makes everyone in the boardroom lean in a little closer. This isn't just a fantasy. It's actually working. Join's monthly video users have shot up by over 30% year-on-year. That's real, tangible momentum. It proves there's a hungry audience for what they're building. This bet, it might just pay off.
But, and there's always a but, right? That impressive growth comes at a cost, and it leads us right to the absolute heart of this whole dilemma. It's a classic business school case study. Focus versus diversification. Two completely different futures for the company. This decision matrix lays it all out perfectly. Let's just walk through it. Path A is to sell that commerce lifeboat. The upside? Bam! You immediately slash about 1.5 billion euros in debt, and more importantly, you get the cash to pour into Join. The downside? You are now completely exposed to that shaky ad market. Path B is to keep the lifeboat. You keep your safety net, but your debt stays sky high, and you basically starve Join of the money it needs to actually compete.
So let's make the case for Path A. Go all in. You sell those commerce assets, maybe for up to 800 million euros. You use that cash to pay down that crippling debt and fund the expensive local shows that are going to make Join a must-have service. You become a lean, focused, pure-play media company, which investors usually love. And, maybe most importantly, you have a clear, independent strategy to fight off that takeover attempt from MFE.
But oh man, the risk is huge.
By selling, you're literally throwing your only lifeboat overboard. You become 100% dependent on an advertising market that we already know is shrinking. What if Join's growth, as promising as it is, just isn't fast enough to make up for the decline in TV ads? You're left with no hedge, and a weak stock price could make you an even easier target for a hostile takeover.
Which brings us right back to this moment. The briefing is over, all the arguments have been made. It is time for you, as a member of this board, to make the call. The vote is now.
The board must decide, do we execute the full sale to double down on the join first strategy, or do we keep our safety net?
So what would you do? This isn't just about numbers on a spreadsheet. It's about vision, it's about risk, and it's about the entire future of a media giant.
Here are your two options, side by side. Option A, sell. Go all in on Join. Bet on your own ability to innovate and fight for your independence. Or option B, retain. Keep the safety net. Admit you can't fight these giants alone and maybe seek a merger. There is no easy answer here. The question is, which future would you choose for ProSieben?